In this video, we're going to look at how we close the revenue and expense account. To understand why we need to close the accounts, we're going to look at some links to the accounting assumptions and qualitative characteristics. First, we're going to start with going concern, which states that our business is assumed to go on and on and on and on. That is why we need the period accounting assumption, which states that time needs to be split up so that we can prepare reports for each period to obtain comparability of results. According to the accrual basis assumption, revenue is recognized when earned and expenses recognized when incurred. And this is done for each period to allow us to calculate profits or losses for each period. And what's the point of all this? It links to relevance, where all this information is important for us to make decisions. I'm going to demonstrate to you how to close the revenue and expense accounts by using what I call the accounting cups. So here I have a cup that represents profit and loss summary account. And in this account is where we pour all our revenue and expenses into. And this allows us to calculate the profits or losses for the period. Let's start with the revenue account. When we record revenue, we always credit the account. But to close the revenue account, we need to debit the revenue account and credit profit and loss summary. This transfers all the revenue into the profit and loss summary account. This is how the journal looks like when we are closing the revenue to the profit and loss summary account. We debit revenue and credit profit and loss summary. Let's look at how we close the revenue account using this example. Here, we're given a trial balance as at 30th of September, and all the revenue items have been highlighted in blue. To close the revenue accounts, we firstly debit discount revenue $500, debit inventory gain $200, debit sales revenue $35,000, but for the sales returns, we credit $1,000 to close the sales returns account. And the reason is because when we are recording sales returns, we always debit the account. Therefore, to close the sales returns account, we need to do the opposite, which is to credit the sales returns account. The net amount is all transferred to the profit and loss summary by crediting the profit and loss summary account $34,700. Here's a snapshot of the revenue ledger accounts after the closing entries have been posted. As we can see here, the sales account has been debited, the sales returns account has been credited, the inventory gains has been debited, and discount revenue has been debited. And the net amounts from all these revenue ledger accounts have been transferred to the profit and loss summary account that has been credited by $34,700. Now let us have a look at the expense accounts. When we record expenses, we always debit the accounts. But to close the expense accounts, we need to credit the expense accounts and debit the profit and loss summary account. And this allows us to transfer all our expenses into the profit and loss summary. This is how the journal looks like when we close the expenses to the profit and loss summary. We credit the expenses account and we debit profit and loss summary account. In this trial balance, all the expense accounts have been highlighted in red. Here's how we're going to close the expense accounts. We credit the expense accounts for the amounts that have been recorded to these expense accounts. And the total from all these expense accounts will be transferred to the profit and loss summary account by debiting the profit and loss summary for the total amount of $31,370. Here's a snapshot of how the expense ledger accounts will look like after we have posted the closing entries. As we can see here, all the expense accounts have been credited to transfer the net amounts out to the profit and loss summary account. I would also like you to take note with what's done in the cost of sales account. Even though we have amounts written on the debit side as well as the credit side, all we need to do is to take the net amount and transfer that out to the profit and loss summary account by crediting the cost of sales account. As we can see here, all the other expense accounts are also credited to transfer the amounts out to the profit and loss summary. And the total expenses are all transferred to the profit and loss summary, and as we can see here, it is recorded on the debit side, the total expenses of $31,370. To determine if we made a profit or a loss, we need to compare the revenues and expenses. When revenues are more than the expenses, we have a profit. When expenses are more than revenues, we have a loss. These formulas here can also help you with your calculations of profits or losses. In this example, we have a profit of $3,330. At the end of the day, all profits or losses made by the business will be transferred to the capital account, which basically represents what the owner's entitlement is. This is how we transfer the profit to the capital account. Once we have determined that we have made a profit based on our calculation in the profit and loss summary account, we can see that the net amount is actually a credit amount. To transfer the profits, we need to debit the profit and loss summary account and credit capital account. This transfers the profits from the profit and loss summary to the capital account. Here's how the journal looks like. We debit the profit and loss summary and credit the capital account. If you think about it, this makes a lot of sense. Profits will increase the capital. Therefore, it makes a lot of sense that our capital account is being credited here. Here's an example using numbers. We have determined that we have made a profit of $3,330. To transfer the profits to the capital account, we debit the profit and loss summary account $3,330 and we credit the capital account for the same amount. Here's how the ledger accounts will look like after we have posted the entry to transfer the profits. As we can see here, we are debiting the profit and loss summary account, and because the other side is the capital account, this is why we write capital in the cross-reference here. In the capital account, we have credited the account $3,330, and because the other side is the profit and loss summary, that is why we write this here in the cross-reference. Once we have transferred the profits, note how we also close the profit and loss summary account by totaling the amounts on both the debit and credit sides. If we made a loss instead, here's how we transfer the losses to the capital account. Once we have determined the losses based on our calculations in the profit and loss summary account, we will notice that the net amount would actually be a debit. Therefore, to transfer the losses out of the profit and loss summary account, we need to credit the profit and loss summary and debit the capital account. And this transfers the losses from the profit and loss summary to the capital account. In the general journals, we credit the profit and loss summary and debit the capital account to transfer the net losses to the capital account. If you think one step further, this makes a lot of sense. Losses will decrease the capital that we have, and therefore it makes sense to debit the capital account. We also need to transfer drawings to the capital account because drawings will also change the owner's entitlement. When we record drawings, we always debit the drawings account. Therefore, when we are transferring the drawings to the capital account, we need to credit the drawings account and debit the capital account. And this is how the journals look like. We credit drawings, debit capital to transfer drawings to the capital account. This makes a lot of sense because drawings will reduce the capital that the owner has, which means that the owner's equity has decreased. Here's an example. The total drawings for September, which includes cash and inventory drawings, was $2,000. to transfer the drawings to the capital account, we need to credit the drawings account $2,000 and debit the capital account $2,000. Here's how the ledger account will look like after we have posted the entry to transfer the drawings to the capital account. As we can see here, we have credited the drawings account $2,000. And because the other side is the capital account, that is why we write capital in the cross-reference here. On the other hand, we have debited the capital account for the amount of $2,000. And because the other side is the drawings account, that is why we write drawings in the cross-reference. Once we have transferred the drawings, as we can see here, we're going to close the drawings account by totaling the amounts on both the debit and credit sides. So from what we have been doing, we can see that the capital account is where everything goes. This man here, he's the owner, and in his hand, he's holding a cup called capital, and this represents his entitlements as the business owner. The capital account is made up of any opening balance, add net profits or less net losses, add contributions, less drawings made. Now we're going to look at the entries made that would increase or decrease the capital account balance. Perhaps we had a net profit that would add to the capital account balance, and this would have been the entry that was taken up to transfer the net profits by debiting the profit and loss summary and crediting the capital account. Perhaps there was a net loss instead, and this entry would have been taken up, where we transferred the net losses to the capital account by crediting profit and loss summary and debiting capital account. Perhaps the owner might have made capital contributions, which would increase the capital account balance. The entry made would have been a debit to the bank or inventory account and a credit to the capital account. The owner might also have made some drawings, which would reduce the capital account balance. In this case, we would have taken up the entry to transfer the drawings amount to the capital account by crediting drawings and debiting capital account. To calculate the closing balance, we take the opening balance, add net profits or less net losses, add contributions, less drawings, and this will give us the closing balance of the capital account as at the end of a period. Here's how the capital ledger account will look like after we have posted all the entries for the period. As we can see here, we had an opening balance of $18,970 at the start of the month, written on the credit side. We also had a capital contribution of $10,000, which adds to the capital account balance. We also had a net profit of $3,330 for the period, which adds to the capital account balance. The owner also made some drawings totaling to $2,000, which reduces the capital account balance. Once we have posted all the entries, we also need to balance the capital account, because this is an owner's equity account, which is a balance sheet item, and therefore we balance it and we bring forward the net balance of $30,300 to the new period.